Today we're going to be talking about 5 ways to invest in the stock market. Now you're going to look online and there's going to be a bunch of different videos on how to invest, how you should invest your money, what you should do with your money in the stock market. Today I'm going to just be breaking down 5 easy ways to invest and different ways to put your money into the market and how everybody does them and just kind of explain them just a little bit. Okay, so starting off at number 1, we got individual stock selection. These are what's known as the Warren Buffetts of the world. Again, these are super rare that they actually end up beating the market. You know, a lot of research goes into this type of investing. You have to do a lot more thinking, a lot more mental gymnastics of going through what you're doing, really knowing the companies that you're putting this money into. You have to know the fundamentals of what you're looking at. So you're looking at companies with solid foundations. That's good debt to equity ratios. You know, you're looking at shareholder equity. Are they getting paid? You know, and growing profit margins are really big in this part of investing. And the biggest part of this is a unique product. You know, what is this company even trying to sell and who are they trying to sell it to? That's going to be a really big part of how you make a solo stock selection, because you need to know, you know, is this product even going to make it? You have to believe in the stock. You have to believe in the company. That's a big part of this type of investment. And it's very hard to beat the market, like I said, you know. Warren Buffett, who is just notorious for his individual stock selection, you know, he has all these big headlines around his name, but he said, in my view, for most people, the best thing to do is own the S&P 500 index. He also said that the trick is not to pick the right company. The trick is to essentially buy all the big companies through the S&P 500, do it consistently, and do it at a very, very low cost. All of that is just to say he realizes that he's just an anomaly in the way that he grew his wealth. I mean, he also doesn't even practice what he preached. In 1951, he bought $10,000 of Geico, and he's telling people not to solo pick these stocks and just to follow a S&P 500 fund, you know. So those are just kind of the Warren Buffetts of the world. That's the individual stock selection side of investing. The next side of investing would be the ETF/mutual fund. This is more of a set it and forget it kind of investor. It's a much easier form of investing. You can buy whatever ETF honestly interests you. That's the best part about it, is there's so many different types of ETFs out there. There's S&P 500 ETF mutual funds, index funds, healthcare sector, you know, there's defense sector, there's small cap, there's international ones, and then there's also like dividend ones like SCHG, which I talked about in one of my previous videos. And the main difference between ETF or a mutual fund or, you know, index fund is that mutual funds are actively managed. So somebody's aiming to beat the market, whereas an ETF is more of a passive. It's set to track the market. So if you're tracking that S&P 500, if you bought an ETF, it would be tracking the S&P 500. If you bought a mutual fund, which is off the top of my head, I think of SWPPX, that's more of an actively managed one where someone's trying to beat the S&P 500 year over year, you know. So whereas mutual funds have a higher expense ratio, ETFs that, you know, track the S&P 500, those ones are like VU, IVV with a 3% expense ratio, or SPY that has a 9% expense ratio. All a percent ratio is just an annual percentage fee for a mutual fund or an ETF that just covers operating costs, management, administration, or just marketing fees in general. So they take a certain cut of your portion. So if it's, you know, 5%, so on a $10,000 investment portfolio, it's $50 annually. So you really want to make sure you know what the expense ratio is that you're getting into if you're going to be doing this type of investing, because those higher investment ratios means that your portfolio is getting nabbed at that percent annually. So you really need to know how much it is, what you're putting your money into, because you could have a good investment on paper, but you're not getting the full returns of what you should be, because that ratio every single year is taking a certain cut of your return. So as much as this form of investing is known as set it and forget it, you still need to do some legwork. You need to look up what you're putting your money into, what the expense ratio is, and really just look up what they kind of follow. You know, is it an S&P 500 ETF or mutual fund? You know, is it a healthcare ETF? Is it a defense, small cap? You need to really understand what you're putting your money into. So even though it's not as much as individual stock selection, you still need to look up and do the legwork of what you're doing. That being said, you also need to understand that having 40 different ETFs that probably cover the same thing is not smart. A lot of people will have 20 different ETFs, 10 different ETFs, and a lot of those things bleed into each other, and you're just holding the same thing. You know, the two biggest parts of it might be NVIDIA in one, and then in the other ETF that you're holding, NVIDIA also is a large portion of what that ETF is holding. So you're not diversifying your portfolio. You're really just putting more eggs into the same basket in a different way and paying another expense ratio on top of that. So you really need to understand and look at what you're putting your money into. Enough about ETFs. Basically, having someone else do the work for you isn't also free, so know your expense ratio. Now on to number 3, crypto. A lot of people don't think that crypto is a part of the market, and to that I say it's just not true. Yes, coins are still relatively new, and many people believe that they're a scam and backed by nothing, and they're super highly volatile. But you still can buy shares of crypto on many of the apps like Schwab, Vanguard. There's all sorts of different tickers for them. iShare has one, Schwab has one that's like a 2 times Bitcoin strategy or a short Bitcoin. Regardless of whether you're buying coins on a brokerage account or you're in Bitcoin app like Coinbase and you're buying these Bitcoins, the money is definitely still there and it's real, but it's very, very easy to lose a lot. Bitcoin was the one that really started the crypto market in 2008. And all of its value is pretty much derived from the fact that there is strict scarcity of Bitcoin. It has a 21 million cap, I believe. So you really just need to be wary and do your research. But Bitcoin, everybody knows about it. Everybody's heard about it, how it went up to $125,000 last year. Right now, it's sitting around 75, I think, I believe, at the time of recording this video. Just understand that it's highly volatile and it fluctuates quickly. So me personally, I bought it when it dipped down to $60,000 and I've been holding it since, and I'm going to continue to hold it because I believe that there is some value in it and there is a future in it. Now, could I be wrong? Sure. But crypto is also a different way of trading, and you just need to be cognizant of that it's highly volatile. So pouring a lot of money into it, it's not proven, basically is what I'm saying. Number 4, day trader. And it's exactly what the name implies. You're doing super frequent trading. You need to understand what you're doing. But a lot of times they're sometimes holding investments for seconds to minutes, and they do a lot more of technical analysis. So there's a lot of brain power and research and time that goes into this trading. Tracking trends using charts, they do price patterns. You really need to understand what you're doing when you're doing this kind of trading. Full-time day traders typically use margin loans, and this allows them to trade in much larger amounts. Now, for the average person like you and me, we're not doing this. This really amps up the stakes of what you're doing, and the profit and risk potential are both equally as high as they are possible to make a lot of gain in money. There's a lot of simple strategies that become involved when you're doing day trading. There's trading the news, because the news does affect the market. When a company breaks with some big news, stock can either go down or up. Most recently I think of Netflix with the hostile takeover, and they do fading, which is basically just shorting the market. You're betting that a stock is overvalued and then it's going to drop back down kind of thing. So that kind of bleeds into options a little bit. And there's also just making a bunch of mini trades throughout the day while you see, based off of your charts, based off of your tracking of the trend and price patterns, that you think that this stock is either going to go up in the next few hours or down or the next few minutes. They make a bunch of micro trades. So the day trader is a full-time job, that you see these movies where they have 3 monitors and they're clicking and graphs, and there's one with trends, and then they're in the market with the one, they're doing all these things, and there's definitely real money to be made here. But for the average person who is just working a 9 to 5 like me or you, or working their day-to-day life, this isn't really a possible thing that we're doing. Is it? Sure, but you have the potential of losing a lot of money. And number 5 is the options trader. If you want to do options, click off this video right now, go to your local casino and just play blackjack, because you're doing the same thing. If you don't know what you're doing, you're going to lose your money. It's very research intensive. It plays into the day trader aspect a lot too, and it can become super convoluted and complicated very quickly. I'm just going to go over a very broad type of options. Personally, I don't do it. It gets very, very risky and dicey if you don't know what you're doing. But that said, with all of that risk, there's a lot of reward in it too. I mean, people make millions of it in a year based off options trading. So you really need to do your time and research and understand what you're doing. Now, call options, they're basically you're buying a stock when expecting the price to increase, or you have the option to buy the stock, I should say. Now, put options is you have the option to sell the stock when you have expecting the price to decrease. And then covered calls are where you own the stock and you're selling call options for a profit. That's just a very broad type of options. Again, I don't do it. I don't really have the intention of doing it. When I want to do something like that, I just go to the casino with my friends. You need to invest a lot of time and research here is basically what I'm telling you. So if you're going to do it, good luck to you. I'm staying out of that type of market. Now I just want to round out the video by going over all 5 and just the key points and takeaways. Individual stock selection. You need to understand what you're doing. Look for the solid foundations in the stock, good debt to equity, shareholder equity, growing profit margins, and understanding what the stock or the company with the stock is trying to sell. Unique products typically sell really well if they're needed in a niche. ETF mutual funds is typically just a set it and forget it kind of mindset. Look into what you want to invest invest in what sector, S&P, healthcare, defense, international is a good way to diversify. Finally, make sure you know the expense ratio. Look up how much of your return is being taken by them in any given year. You need to know that. It's the one thing that you really need to know going into your ETF or mutual fund. And mutual funds are more actively managed. ETFs are typically more passive. Crypto, coins are relatively still new. It's highly volatile. Bitcoin can make you a lot of money. It can also make you lose a lot of money. So you need to just be wary of that. The money is definitely real in there, but it's an easy way to lose a lot. Day trading is exactly what it sounds like. You need to understand it kind of ties in with the solo stock picker and the options trader. They kind of blend a little bit. It's super frequent trading. A lot of them take out loans to use these high capital and trade a lot more in larger amounts to increase these gains. They typically hold for seconds, minutes, maybe day. It depends, but they're doing a lot of stuff in one day. They do a lot of tracking using charts, price patterns, and basing off the news. You have to kind of be cognizant of what's happening on any given day. And then finally, the options trader or just the gambler. I mean, if you don't know what you're doing, stay out of it. That would be my advice. It's very research intensive and it gets crazy really quick. The options, the calls, the puts, you can lose a lot of money or make a lot of money very quickly. So if you know what you're doing, go ahead and keep doing it. If you don't, I would suggest picking another route. And also, there's no set in stone rule that you can't be a combination of both. If you want to do a little bit of options trading while keeping a lot of your money in ETFs and safer things, then you should go right ahead and do that, Or if you want to just pick some solo stocks and some ETFs, personally, that's what I like to do in my personal brokerage account. It's fun, you're not doing too much risk. I bought Netflix a lot when it dipped and now it's doing much better. So picking these stocks, holding them for, X amount of years or X amount of time, that's really up to you. But if you want to do something like that, it's all about, in a way, maximizing your return, but also keeping yourself in the market. So however you're going to do that, if you're going to pick some stocks and do ETFs just for some fun and to feel like you're, doing something fun and doing something that you're enjoying, I'm going to tell you to do that. I'm not going to tell you not to do that. It's a good way to help yourself stay in the market. And every time you pick something, it has the risk of going up and down. It's the same thing with ETFs as it is with picking a solo stock. You just need to educate yourself, do the time, know your risk, and most of all, have your emergency fund for if you're going to be putting money in the market. You need that fund for 3 to 6 months of your life expenses. Do not forget to have that. Thanks for watching today, guys. Make sure to hit that subscribe button, hit the like button, the post notification bell. Drop a comment below of what you're doing, what you're buying. I like to know and see what my community is doing, so definitely tell me, or any feedback on the video, let me know. If you like the Battlefield 6 gameplay, definitely let me know. I'll be playing a bunch of different games. All right, that's it from me, guys. Peace.